Welcome back to the mini course series. In today's video, we're going to be going over liquidity in lesson 7. Now, it's not going to be me leading this lesson, actually. I am bringing up one of my head crypto traders. His name is JDE Trades, and he's going to be teaching you guys about liquidity. So I'm going to pass it over to him.
All right, boys. In this video, I'm going to be showing you what is liquidity, why does it matter, how do we use it, and let's get into it. So, first things first is understanding that liquidity is just orders, right? That's all that liquidity is. It's orders that are either resting below price or orders that are resting above price. That is it. It's another form of support and resistance. And why that is it's because it's an influx of orders. And in order for price to move in one direction or another, which we know price can move in 3 ways, we can trend up, we can trend down, or we can consolidate. But in order for any of these things to happen, orders need to be filled, right? Longs need to be filled in order to push price up. Sellers need to be filled in order to push price down. And then obviously, we're always going to have healthy periods of consolidation, but we're not really talking about consolidation today. We're talking about the big moves in the market, how institutions use liquidity, and how they use them to push price in the direction that they want it to go. So, I use liquidity on the 5-minute, the 15-minute, and the 1-hour time frame. I don't use it on the 1 minute. I don't use it on the 4-hour. I don't use it on the daily, right? And why I use it on those time frames and not the others is because I trade an intraday trading type of strategy, and I'm trading off of the 1 minute. So I'm only looking for these key levels throughout the intraday. I'm not looking for key levels in order to swing trade off of. The best way to think about liquidity before we go ahead and spot it is it's like price is a car, right? And if price is a car, and we want to get to our home, regardless of if our home is above or below, in order for us to get to our home, we need to do what? Get gas, because our car is running out of gas. So let's say, for example, our home was down here, and this is our home, and we have a gas station right up here. And in order for price to go ahead and make the move home, even though the gas station is out of the way, we need to put gas or fuel in our car so that we can continue on the direction that we really want to go in. So the car is going to go ahead, make the stop at the gas station, fill up on orders or fill up on fuel, and then it can go ahead and make the move because now we have the momentum or the volume or the gas in this example to make the move that we really want to go in. So all we're going to do is we're going to look at price in 2 different ways today. We're going to look at it in a bullish trend, right, where we're making higher highs and higher lows. I don't even know how those balloons just got there. But we're going to look at it how we go down as well, right, where we're making lower highs and lower lows, right? So in today's example, we're not talking about consolidation. We're not talking about chop. All we're talking about is trends up and trends down, and where can we spot these draws in liquidity and why are they important. So, for example here, we can see, and I'm going to go ahead and use replay mode, and replay mode is an awesome tool to kind of understand some of these confluences that we've taught within this course. All we're going to do is we're on the 1-hour time frame here, and all we're going to do is identify a trend. So if I use my trend line, I could say, boom, awesome, price is going up. How do I know that price is going up? Well, because we are making higher highs and higher lows, and we are continuing on this trend for the past, week and a half here. So I could tell you that price is going up. And in order for price to continue going up, we need to fill orders. So on the 1 hour, I've identified that we are in a bullish trend. And now I'm going to scale down to the 15-minute to kind of identify some of these draws in liquidity or these pools of orders, however you want to think about them. So I'm on the 15-minute time frame, and I know that price is clearly trending up. We are bouncing off of our trend, and I know that we still want to keep going up. And in order for our car, which is down here, to get up to these highs, right, what do we need to do? We need to fill longs orders, and we need to take out shorts stop losses. So for example, at all points in time, there's going to be orders. There's going to be shorts, and there's going to be longs. There's going to be buyers, and there's going to be sellers. And if I was in a short position, anywhere within this range, I'm going to be setting my stop loss at these highs, right? And then the vice versa. If I was in a long position anywhere in this range, I'm going to be setting my stop loss at these previous lows, these previous swing lows. And why that is because most retail traders and most traders in general understand that if price breaks a key level, it's going to continue pushing through that direction, and we do not want price to revisit these swing highs or swing lows. So again, if I'm in a short position, I'm going to have my stop loss up at these highs, right? And if I'm in a long position, I'm going to have my stop loss down at these lows. Now, liquidity is not just stop losses of shorts and longs, but it is also limit orders or pending orders of longs and shorts, right? So we know that price wants to continue higher, but we know that we are so far away from this trend and that we have made such a huge move up that in order for our car price to continue heading higher, all we need to do is fill some of these resting long orders that are sitting below swing levels, right? So all that I do is I take my line tool or my horizontal ray and I mark out some of these swing levels, right? So we have swing lows here, we have swing lows here, and then we have swing lows down here, right? And you can mark it at the wick, you can mark it at the body. Just understanding we're looking at a range, we're not looking at a specific level, right? And then we also have liquidity down here. The one thing that I will say is that if we are obviously in a trend and we're respecting our trend, we're not always going to come down and fill all of the orders. Does that mean that there are not orders down here? No. There's absolutely longs orders right here, and there's stop loss orders as well, right? There's absolutely orders resting at that level. But in the example that we're looking at today, clearly price didn't want to go ahead down to that level and sweep that out. So we're just going to delete that for now, right? We only want to look at liquidity that is local to where our price is at and local to, what we're looking to trade, which again, we're not swing trading, which is why I really only look for liquidity on the 5-minute, the 15-minute, and the hourly time frame. So price is our car, and all we did is we went ahead and we filled some of these orders that were resting below price, right? Orders that were resting below these swing levels. So price sweeping below this level and showing us this rejection, right? These bullish candles out of here. It's about an hour of price showing us that we want to reject off of these levels. All that that's showing me is that our car got gas. We're still respecting our trend, and now the car wants to go home. So we're filled up on fuel, and now we can let price go ahead, play out, and pick the direction that it wants to go in. And boom, as you can see here, price went ahead. We continued higher as we expected because we filled up on gas. Price filled all these orders, and we went ahead and we made our move to the buy side. And you're going to hear me say buy side and sell side a lot. And what I mean by that is buy side is obviously the highs, right? And sell side is obviously the lows. So now we're going to talk about buy side and sell side. And what I mean by buy side and sell side is these are the areas that price has these draws and liquidity resting at. So for example, price has buy side liquidity resting above and price has sell side liquidity resting below, right? Why that is because shorts want to push price lower, buyers want to push price higher. It's very, very simple. So what can we see in price here? We can see that we made our move down. Our car made the move down to get gas, fill all of these orders from these swing lows here, right? Here, 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 and here, sweeping out all of these liquidity pools or all these draws of liquidity. And then we went ahead and we made our move to the buy side. Now, what do I mean by buy side? Buy side, I mean we have all these resting orders above, right? And buyers are now going to try and push price higher, which we ended up doing after we swept out all these lows. So now that we have our understanding of sell side liquidity and the understanding of if our car wants to go higher, we need to first go lower first to fill these orders, then we can make our move. It's the exact opposite with buy side liquidity, right? If price wants to now go lower, we need to do what? Fill our sell orders, fill our buyers take profits, fill our sellers stop losses. Because again, if we delete everything on the chart here, you have to think about it like this. If buyers are up here, their take profits are at this level up here, right? They're looking to take profit at this key level where we can see there's a ton of equal highs. What I mean by equal highs is that there's highs that are all touching the same area of price, right? And we could see 1, 2, 3, 4, 5, 6, almost 6, 7 levels that are touching our buy side liquidity, right? And what's happening in this range is that we have these buyers that are taking profit at this level. And we also have shorters, right? People that are looking to short this market or already were in a short position that ended up getting stopped out at those levels, right? So longs are taking profits, shorts are getting stopped out. And now that we are making our push above price, right? Or above our buy side liquidity, what do we expect to happen? We expect to see a sharp retracement downwards. And why that is because we just filled all of the short orders that were resting above these swing highs. We just filled all of our longs take profits that were resting at these highs. And we also just filled all the previous sellers stop losses that were also resting at these highs, right? So in order for these institutions to make their move down, which was where I expect price to go, or in order for them to make their move up, which we could see on that previous move here, we need to get gas in the tank, right? The car needs to be filled with gas or orders so that price can continue in whatever direction it wants to go. So we can see here we got that big spike or that big displacement above price, sweeping out all of these previous highs. And why they're so important is because if we go back to the hourly, there are no other local, remember, local is very important. There are no other local highs other than if we were to look all the way back to February, or the beginning of this year, right? That was the last time that we saw any previous price action at this $240 to $246 range. So we're going to scale back down to the 15-minute. We've identified our equal highs here, 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 and here that are all resting above price. This is our buy side liquidity at these swing highs. What happens? Price pushes above it, fills all these orders, and then from there you can see we ended up making our move down. It took a while. We had some consolidation, but from there we never revisited this swing high, and we ended up getting enough gas in the tank to move price lower. Now, again, I did not always use liquidity for every single pool, because if you did, you would literally have 1,000 lines on your chart, always expecting price to fill every single one of those lines before making a move, right? And that's just not how price works. And I sure as hell don't want my chart to look like a freaking barcode, right? So the way that I kind of filter out draws in liquidity that are important versus draws in liquidity that are not important is by using the 1 hour time frame. And by using the 1 hour time frame, it kind of filters out a lot of that nonsense price action that really isn't there. And if you want to just have the simplest way to mark out liquidity without going down to the 5-minute, without going down to the 15-minute, and by just using the hourly time frame, all you're going to do is take your horizontal reg tool and mark up swing highs or lows or areas that we have a heavy consolidation followed by a big move, right? Same thing, hourly time frame. I see this pool here where we had that heavy consolidation or these swing highs. We have this pool here where we had that heavy consolidation and these swing lows. And then here we have our swing low here where price made that big move off of after. And we also have our swing high up here, and then so on and so forth. You can just continue going on and marking up levels that price has not reacted off of yet. So I'm going to go ahead and do it now off of the 1 hour here for our final example. All I'm going to do is mark out these swing highs, which we have as equal highs here. Again, the more equal highs and the more equal lows we have just means it's a more powerful or a more impactful draw of liquidity, meaning that there's going to be more orders in this range that have yet to be filled, so that when price does fill these orders, it's going to make a heavy move off of them. So we have that line there. We have our swing high. We have this line here. We have our swing low. And if you really want, you can go ahead and mark out the swing highs and swing lows between these ranges. For example, we have these equal highs here. We have this swing high here on this bullish candle. And we have this swing high here on this bullish candle, followed by this big displacement move to the sell side. So what happens if we go back down to the hourly and we see this big bearish candle, right? What happens after we go ahead and we fill this main draw in liquidity here? Well, we can see that we got a sharp rejection off of this level. Now, I'm not too sure if price continued higher or lower, but what I can say, and okay, we did end up going higher, but what I can say is that when you fill an influx of orders in the market, you're going to have a reaction off of them. And all we're looking to do as traders is find these levels where we can find reactions from and then scale down, right? So I'm going to use replay mode, go back, look that I could see we have our sweep of the liquidity here. And go back down to the 5 minute, go back down to the 1 minute, and now I can look for trend lines and look to identify trades to, potentially catch to the other direction. Because as you know, we trade reversals, so all we're looking to do is watch orders in the market get filled, or back to that analogy from earlier, all we want to see is our car, right? Our car fill orders in the market or fill up on gas so that we can make our move home, which is whatever direction the smart money wants to go. That's the best way I can explain liquidity. If you have any other questions, ask me in the Discord, and I'll see you guys in the next one. Peace.